Okay, hello everybody. Thank you for joining us for today's webinar. Investment opportunities for boutique consultancies either side of the Atlantic. And really delighted to be welcoming two fantastic speakers alongside me today. We've got Karen Thomas Bland, also David Jorgenson. They'll be introducing themselves shortly. But we'll just let everybody get settled in because as ever, there's a large number of people joining and no doubt finishing a meeting. So coming in hot off the back of that. Really excited to see such strong registration levels for so early in the year. So when I took a look at the list earlier today, there's a mix of clients, regular attendees, thank you to those, and a number of new people as well. So whoever you are, sparing an hour of your time whilst you're busy getting 2024 underway is really appreciated. For those who don't know me, I'm Ben Edwards. I'm the head of partnerships here at CMap. We're a PSA solution for consultancies. And as ever, I'm going to be running today's session. Today's topic's around investment opportunities for consultancies in North America and the UK. And it's often part of a firm's leadership's thinking when they start, they scale, professionalize their firm. And as a PSA solution at the heart of a consultancy's sales ops and finance functions, we find that we can come in of value. So that's why we're hosting today's session. So acquirers, banks, M&A advisors will be looking for real-time insights, forward-looking visibility into a firm's project profitability, pipeline, engagement management, resourcing, staff utilization, a number of KPIs and success indicators that are easily accessible through PSA solution. Over the past couple of years, we've seen plenty of firms, clients of ours, take on PE investment, also go through MBOs, EOTs, exits, pursue M&A opportunities themselves. So we know for our clients and for the broader consultant community, this would be a really interesting subject. And obviously, we're starting here in January, so we've got the full 12 months to look forward to with our speakers. This bit of advice mainly for new attendees. We've been running these insight sessions like the Zero CMap product every month now for nearly 2 years. In 2023, our industry experts, consultancy leaders collectively delivered hours of insights into every facet of a consulting firm's business practice. So think best-in-class people strategies, the back end of last year, the impact of AI in consulting, growing internationally, building a unique brand and proposition. So we've got a really great bank of webinars, all following the same format of today, which you can consume by using the link in the chat. So feel free to look at those. They're in chronological order there. If you wanted to see broader consulting content, webinars, but also blogs, video snippets, long form articles, then that's available on our resources page. So I'll just copy and paste those into so everybody can see. Going into the chat now. So do click on those links and you'll be able to access the content after today's session. But as I mentioned, back to today, joined by two brilliant panelists. They're going to introduce themselves, but from my side, I want to give you all some context as to why I was keen to have them participate, because I know you're going to be getting great value. Karen is a non-exec at two exciting UK HQ consultancies, built a fantastic career in big consulting firms, vast experience in an M&A, prominent figure in boutique consulting, great on LinkedIn, so follow her for lots of great insight into our world as well. And from David, well, actually we ran a session with Equiteq over 12 months ago now with his EMEA-based colleague Jerome, really popular. We often see their M&A work through mutual clients and also in the broader market as well. So I'm really delighted to be welcoming David too. Now, 3 quick housekeeping elements. So as ever, feel free to ask questions throughout using the Zoom questions tab. They only get put to me, so I will see them. None of the other audience members get to see them, and then I'll put them through to the panelists at the end of the session. But ask them as they enter your mind so that when we come to the Q&A piece at the end, we've got those ready and prepared. This webinar is also being recorded, so an open access link is going to get sent through to your inbox tomorrow morning, and you can rewatch it, you can share it with colleagues. And the format as well. So it's a panel style format. We'll have the introductions, and then we've got 4 key topics that we're going to be running through, spending sort of 8 to 10 minutes across each, and then having the Q&A at the end. So an hour is how long we've got. Well, 55 minutes now. We're going to make the most of the time that we've got. So starting with very high level topics, then progressively getting deeper. So let's get into it. Delighted to welcome our panelists. Karen, be great to get your introduction first, please.
Fantastic. Thank you, Ben. Well, good to meet all of you virtually. I hope you're having a good morning or afternoon, depending where you're dialing in from. So just a little bit of background to me. I had a bit of a non-traditional start in consultancy, as I actually trained initially as a business psychologist. So I became a chartered psychologist first, predominantly because I'm really interested in the people side of business. So classically, change management, org design, people assessment and development, the people side of M&A. And I started life in boutique consultancies. So very much anywhere between 20 and 100 people. And we had in mind some kind of exit or transaction, whether that was to PE or to trade or whatever that might be. So I worked my way up through that boutique consultancies. And then I ended up joining KPMG in London. They'd sold their business off, their consulting business off to Atos. And so I came in really as fresh as it could be in a business to build up their strategy and transformation practice, which I did. So that was everything from selling and delivering large transformations and integrations, but it was also classically building a practice, so building methodologies, building IP, hiring the right people, all the things that you guys listening, I'm sure, will have lots and lots of experience in as well. So tracked out of KPMG and I relocated to the other side of the pond. So I went to the US quite deliberately. I joined IBM. It's obviously headquartered in the US, and so I wanted to be where the art of the action was. And I did a number of things in IBM. One was highly acquisitive, so I made about 10 acquisitions, both on software and services during that time. I also ran IBM's global transformation. I ran global client accounts. I was a service line leader, an industry leader. So you name it in consultancy, I did probably all the different roles. But I did end up relocating with IBM then to the Middle East. So I went to Dubai to run a big business, actually. It was a $4.5 billion big part of our business. And that integrated both software and services. And we'd launched Smart Planet. So we were thinking about data analytics, AI, and all the themes that we talk about today. And then finally, I went to Brazil in Sao Paulo to do what you'd call a classic turnaround. So we'd lost share. So this was kind of a business that wasn't performing to the way we'd hoped. And so I went in and did that classic turnaround with the management team. So that takes me to 30 years ago. I then left IBM. I relocated back to the UK, and I decided to do two things. So one, work with boutique consultancy owners, either as chair, non-exec or advisor. I wanted to help them scale their businesses and ultimately get whatever exit they were looking for. And so I've been on the board of about 12 different businesses, some of which will be pure service businesses, and others which will straddle both services and software. And then the other part of my job is I still have my hands in on consulting, so I still do large scale transformation and M&A integrations for the listed world. So they're obviously the big transactions. That's probably bringing you kind of up to date. I think I look at, if I think about the boutique landscape and what I do there, I work on everything as you would imagine in these smaller businesses, from, working with the founder on their strategy and value creation plan, thinking about how do you scale up your people and how do you retain that kind of entrepreneurial culture, everything from go to market. So how do you really kind of automate your sales and marketing engine, and how do you create that IP and potentially even a product so that you get some reoccurring kind of revenue in the business. So really excited to be here. I think I will terminate my introduction there and let David jump in.
Thanks, Karen. That was brilliant. Yeah, and David, over to you.
Great. Thanks, Ben. And really appreciate the opportunity to be here with you today. And thanks to all of you for joining. I'm excited to spend an hour talking about the landscape and the opportunities. So my career, I'll run through it pretty quickly, just a couple of movements. I started as a consultant myself, working when the internet was sort of new, working on helping companies transition their commercial presence onto sort of the new infrastructure of the internet. And then I got into the finance side and have spent my career in investment banking for about the last 22 years, working on helping businesses make sense of the market and address the market for capital. So the first part of that career was at a firm called Robert W. Baird in Chicago, which was a larger middle market firm. And I was working on deals anywhere up to $2 billion in size, always in the services ecosystem. So typically with a business services framework or a tech services framework. And that was all M&A work. It was board advisory. It was public market, IPOs and secondary offerings. So fairly broad experience. What I found I really liked the most in that part of my career was working with founders who had built a business and needed guidance and assistance in navigating the market for finding liquidity, finding opportunity for their business, finding a home for their business. That's what was the most fun for me in that part of my career, and I really wanted to do that more. And I saw my time at Baird probably taking me a little bit away from that. And so I decided to join Equiteq, which was at that time quite a small firm based in London. Equiteq had been started by Paul Collins, who's currently our chairman, after he built and sold his own consulting firm back in 2002, and he felt like he didn't get the quality or the outcome of advice that he would have wanted to get in hindsight. So he started Equiteq really to give better advice to owner entrepreneurs in the consulting and tech services ecosystems. And so I joined Equiteq about 10 years later in 2014 with an idea that we could turn that core advisory perspective into a global investment banking sell-side M&A platform, which we've done. So we are currently based in 3 core geographies. In North America, out of our U.S. Operation, or in New York. In Europe, we're based in London and Paris, and in Asia, in Singapore and Sydney. So Equiteq now has people in all of what we consider to be the 3 core geographies for specialty consulting and tech services. I'm currently the CEO, so I took over as CEO in 2016. And what we do every day and what I do every day is help business owners make sense of complexity and make sense of the uncertainty of what opportunities are available to them and when, how much, and how to find the best home for the business that they've built. And so that's been a very rewarding part of my career, and I do that both as the leader of Equiteq to make sure that our global platform is well positioned for growth ourselves, but also as a practitioner. So I manage client engagements on my own, and that's continues to be the most fun part of the job.
2 perfect intros. Great to get that overview of your experiences. So let's get into the topics themselves. First off, going to evaluate what investment options are open to boutique consultancies. Obviously, the headline is around PE, and that's going to be where we spend the most of our time. And then we're going to delve more into the why and the how and the when behind it. So Karen, what options are available to firms?
Yeah, absolutely, Ben. So there's a few options. Let me just quickly walk through those. So if you're an early stage business, and by that I might think about sort of under 2 million of revenue in the UK, you might start thinking either about angel investing or VC investment, venture capital. It's not classically always the right market for pure, what I might call people-based pyramid sort of consulting. It's classically more for software, but I do see those transactions happen. So, if you're at that stage and you're thinking early, that might be an option. Second option, if you're building IP, that may be going into a product, but if you're just kind of codifying your methodologies. There might be grants available. And again, I've worked with boutique consultancies who've been able to get funding that way. You might also, if you're a founder and you've kind of built the next layer, so you've got that kind of management team in, maybe you've brought a finance lead in, a CEO, and so on, there's potential for a management buyout if, as a founder, you're looking for an exit. You could also go down the traditional route, which is to go to a bank and get, you know, classic funding that way. And then you might also think about PE investment, which I know we'll talk a lot about today. And there's a couple of nuances, I'd say, with PE investment. One, you might be thinking about minority or majority stake. Both bring a different dimension into the business, and a lot is, you know, kind of what control do you want to keep on the business. The other dimension you might want to think about with PE is how interventionist the particular PE house is. So you've got some who are very high interventionist, you know, will want to work closely with you in the business, to people who would just classically kind of put their money in. And again, you get a different flavor. You know, a classic interventionist PE would probably involve a professional board, probably an independent non-exec, probably an investor director sitting on the board, and so on. And finally, you know, as another option, you might be thinking about a trade sale. So again, depending on size, you might, you know, aspire to be bought by a EY, Accentures of the world. So broadly, you've got a range of options, and it's often really about, I guess, two things. One, how mature are you as a business, and what of those feels kind of the best? And then the second one is about the why. Why are you seeking investment? What do you want for it, which will guide which route potentially you would go down.
Yeah, I think that's a good point around maturity. You know, I think where Equiteq tends to become involved with giving advice to growing businesses is really when you've achieved a level of scale or size that starts to broaden your opportunity set. So I think where Karen started there was with, you know, thinking about seed or angel investing. That is when things are more in the idea stage than in the realization, which I think is a really critical, you know, phase in a life cycle of a growing business. But where we tend to start to give advice is when there's been, you know, maybe the revenues have come up, you know, above 5, above 10, above 15 million annually. And that's when, you know, the range of options tends to open up a bit, in the sense that you might have more potential investors available to you. And I think we think about the broader categories, really where Karen finished her answer, where trade is a critical category, private equity is a critical category. And we find that there's as businesses get bigger, the MBO option becomes a little bit more difficult, a little bit more complicated, because typically, while businesses in the consulting and tech services space are typically high cash flow, it's hard to approximate market values through an internal transfer like an MBO. So that's that's the one that gets a bit more challenging as you scale. The one point sort of I'll make about the market and opportunity is the private equity opportunity has really changed and evolved significantly over the past 5 years. Certainly over the past 10, but even in the last 5, I think that option has become much more interesting, much more exciting, I think, for business owners. And the options within that broad category are becoming much more diverse. And so, as Karen mentioned, you can find investors who just want to put money in. You can find investors who want to be part of the management team. And so I think compared to 5 or 10 years ago, when there really weren't that many private equity businesses that were comfortable with people-dominated business models, you know, that's really changed. And I think it's a much more exciting avenue for a founder-owner business, a business grower entrepreneur than it used to be.
Perfect. And now looking at the market, it'd be interesting to get your views on the past year, i.e. 2023, and any foresight you've got heading into 2024.
So I think that last year was a year that, the way I describe it to people in my team, is we're going to remember last year. You know, it's going to be a year that is a number you'll remember, and you'll think, oh, yeah, that was a weird one, because it was challenging for different reasons at different times. But what we saw consistently across the market were businesses that were approaching the corporate customer had and providing a value-added service, and it didn't really matter even how value-added it was. There were disruptions in their revenue predictability. So almost all of our clients last year across the specialty consulting and the tech services sort of digital ecosystem, they all had 1 or 2 quarters where their own revenue picture got a little cloudy. So it was a little bit harder to predict when things were going to happen. And those things might have been deliveries, or they might have been just sales. So contracting was a little bit slower. Their buyers were a little bit more hesitant, asking a few more questions, taking a few more weeks to make decisions or to sign paper. And so it was a challenging year in the sense that it was just harder to predict. And I think you can see that all the way through, from trying to predict interest rates to trying to predict when a contract was going to get signed. It was just a year where certainty was a challenge. And I think that affected the M&A market significantly, because I think when you're talking about closing an M&A transaction or an investment at that scale, it's very, very difficult to do in any year. But when you don't know which direction the market's going, or which direction interest rates are going, or which direction clients are going, it makes it even more difficult. So I think it was a hard year. I think it's a year we'll remember for that reason. And our just a short piece on 2024. We feel like the corner is being turned on that. Early to say yet, and not really sure how quickly that's going to happen. But I feel like there's a point there will be a point in 2024 when we feel like that period of uncertainty is behind us. I just don't exactly know when that's going to be.
Yeah, and I agree with everything David said. I guess a few nuances from my perspective. I think, I categorize it the same. I think 2023 was a tough year. However, there were some consultancies that did buck that trend and just outperformed the market. And so I came at this from thinking, what were the things that they were doing? And there were a few themes that came to mind for me. And I think one, specialists won the day. So you would have a tough year if you were a generalist sort of consulting practice in 2023. I think the real kind of outperformers had, defined a really clear value proposition. They've really focused on those multi-year kind of client relationships. They probably added, you can talk about dependency in a negative way, but if they had a tech dependency, it often proved out really well. So, if they had 1 or 2 close vendor relationships, they were really kind of pulling work through. And I think it worked well for businesses that had got that IP kind of codified. And again, they may not have gone the full extent into building a product, but they'd got an asset that just was beyond kind of people. And I think, the other one, especially if you compare to kind of big consultancies, is they use their entrepreneurial kind of scale up nature as a bit of an advantage. And I saw this in terms of that nimbleness, nimble at responding to opportunities, flexible on commercials, and that's not about reducing the rate card, but it was about showing that flexibility and more agility, because again, to all that David said about the uncertainty and deals moving out, agility was needed as clients' kind of conditions were changing. I think the other thing they did was quantified value. Like we're all ex-consultants and consultants ourselves. And I think one thing consultants can classically struggle with is we love to talk about approaches. We can talk about methodologies, until the cow comes home. But if you can't quantifiably demonstrate your impact on a client business in financial terms, it's really tough if you haven't put that into your proposals and across all your kind of marketing channels. So my summary is, it was a tough year for generalists. It was a really tough year if you were faced into the public sector, certainly in the UK market. And it was a tough year if you were working, let's say, in a technology that was right at the end of the hype cycle. So it would become like a commoditized play. I'll end in the same way as my prediction for 2024. I do share David's optimism as well. I think all what I've said applies still. So I think all those are good trends to keep in mind. I think the M&A market is showing signs of improvement. We're seeing kind of green shoots. I anticipate more deals than 2023. I don't think we'll be in the dizzy heights of 2022. But there's probably 4 areas I think will be really in demand. One would be the practical application of Gen AI. I think any consultancy who's working on that will be a hot space. I think digital transformation will continue to be hot. And I think from a sector perspective, life sciences and energy transition. Again, don't worry if you're listening to this and running a boutique transformation consultancy. I think there's still all to play for, but I think those areas will be particularly hot.
Perfect. David, did you want to jump in and add something else before we move on to the next topic?
Well, I think that what we're seeing is very strong tailwinds in the transition of economic actors into more digital infrastructure and tech enabled infrastructure. That doesn't mean, though, that you need to be a digital transformation firm to take advantage of that. So and I'm sure everybody listening to this, has visibility into their own clients, how their own clients are approaching this. But from our perspective, the world is absolutely transitioning more towards tech, and AI is a great example where that might even continue to accelerate. However, that has implications across the business models of large corporate clients that are well beyond the sort of the technology infrastructure or even the software infrastructure. So, I believe that there is a strong tailwind that has a long way to run, certainly longer than my career, in the continued transition to digital. And digital transformation, digital impact, and changing business models driven by technology change. But it doesn't mean you have to be a tech firm to take advantage of it. So I would encourage non-tech specialty consulting firms, whatever your specialty is, to think carefully about how technology is transitioning their customers' businesses, because you can play that even if you don't do tech.
Very good. I know I said I'd leave Q&A to the end and for people to ask them, but we did have a good question that came in that's relevant to what we're talking about, is if 2024 isn't maybe as optimistic and maybe a bit lumpy, should somebody time their transaction based on the market conditions? Do you have any broad advice around that?
So our perspective and the advice that we give very consistently is you can't time the market. And the reason why we say that is because it's not quite as clear as that. The underlying reality is that you're much better off working on the things that Karen was talking about. And when you have those things right, that's your time. And we saw very strong outcomes even last year in a challenging M&A market for businesses that had those things lined up. And so it would have been a huge mistake for them to wait for a quote unquote better market, because their positioning was perfect. And so our advice is get your assets right, get your value prop, your visibility, your client relationship story, your people story, and your synergy story right. That's your time. And I think thinking about external market conditions will, on average, be a dilutive sort of approach for most business owners. And so we don't time the market. We really try and time the business, if you know what I mean.
Yeah, perfect. So let's have a look at the next topic now. So for those people on the call who want to get themselves ready, and what type of things should a founder, somebody in the leadership position within a consultancy, consider to set themselves up for success? So when they're coming in to evaluate their options or maybe progress their options, they're in a really strong place. David, you've 12 years of this. Karen, sounds like you've done 50 plus of these types of deals. So you've no doubt both got a ton of things that you've seen work well, work poorly. What really are the key areas that people listening in should focus in on as they're preparing to sort of make their decision and go through some sort of deal? Happy for either of you to take it
Sure, I'm
first.
happy to go. Yeah, okay.
Yeah.
I'm happy to go first then, Ben. Yeah, I think there's a few areas to focus on. So depending where you are in kind of your business kind of growth cycle, I think one for me is around market opportunity. So if you're relatively early stage, have you identified that there's a market opportunity that you're targeting? Is it growing? And can you address that opportunity in different market conditions? So in a downturn and an upturn market. So one's that. Second for me, which I've mentioned, is about your proposition. So is it really differentiated from the competition, and do you communicate it across all your channels? One of the first things I do, when I'm working with a consultancy is look at the website. What does your shop window tell you? And quite often then people will say, oh, well, it doesn't tell us how we are now because we've evolved. So just make sure that you've got a consistent value proposition communicated. Really important is around your sales and profit growth. So you really need to be tracking on, what's your historical growth, what's your forecast, are you growing X% year on year? What is the average size of your engagement trending upwards? What's the strength of your client relationships? So often talk about reoccurring business. So do you have the same clients coming back to you? How much is referred work? What's the quality of your fee income? So what's your, again, mentioned recurring revenue? What's your profit margin? Is your utilization consistently high? Do you have IP in the business? Do you have a door opener product? People, do you retain and attract really good people? Are you keeping turnover lower than average? Are you creating a culture that people love and they want to come and work in, and they'd rather join you than kind of Accenture? And then how strong is your leadership bench in essence? So how strong is your management team? And obviously, if you're an earlier stage business, maybe you've not got an FD or a CFO, but have you thought about those gaps that you want to fill? So those are very broad range. I'm sure David's got more examples, but those are the sorts of things that I'd be thinking about.
Yeah, so we sometimes we try and boil this down to just a few. And so we've kind of got a top 3 things that we think, questions you need to answer. And we sneak a fourth in. I'll show you how we do that. But so the top 3 are, why do you exist? What are you doing that the market needs? So think about that as your unique value prop. Second is your client relationships and in the broad scope of who are you working for, and why is it stable and predictable, and how impressive are your clients, and then why are you thinking about a transaction? Why do you what do you need? And it's okay to just need money, but a lot of times businesses that grow up in the services space, in the tech services and specialty consulting space, they actually need something from the partner as well. So what do you need? And I think if you can answer those 3 questions compellingly, then you are in a great position to find a partner. A lot of the things that Karen was talking about are subsidiary points in those big points. But why do you exist? Who are you working with? And why do you need a deal, right? And then when I was talking about sneaking in a fourth, the fourth is the assumption that the financial infrastructure is solid. So predictable growth, profitable, and the scale of your profitability. So how much EBITDA do you have? As I was mentioning earlier, getting above, in the US at least, getting above 3 million of EBITDA is an important threshold. 5 is the next threshold. 10 of EBITDA is a massive threshold as well. But stepping up the scale of your profitability is important. But having that financial infrastructure, those are table stakes. That has to be there. But those are the top 3 if I had to think about it, Ben.
Perfect, thanks. And have you found it a bit lower in the UK from an EBITDA perspective, right, Karen?
Yeah, I mean, certainly I've seen investments where the business is not yet profitable. So again, if you're listening to this and you're pre-profit, I wouldn't worry. I think 1 million of EBITDA is a really good benchmark in the UK. So I think if you've got 1 million, you will have a more competitive process for your next transaction. So more people interested and therefore not likely to be a drag on valuation. So that's the kind of benchmark I have in mind, but I've certainly seen it happen earlier than that. So I wouldn't want people listening to think, that's, if I haven't got that, I'm out of the woods, out of the game. You're not.
No.
But think about, but I think it's so important. I think David made the point. The timing's got to be right for you and your business. So also be driven by that as well.
What are some of the most overlooked type of things that people have during like any sort of transaction, or any things that people just assume aren't important but actually become really significant?
So I think from my perspective, the surprise, if you're a founder, a client of ours, and it's the first time you've taken on investment or done a deal, I think that the biggest surprise is how important every little detail becomes. I'm thinking of a particular situation of a deal we closed in December, where if the founder in December had been able to talk to himself in June, before we started the deal, I haven't asked him this question, but my guess is he would have said the details. The story's important, but make sure that all the details line up. So, typically, even with the most constructive and relationship-driven private equities, the details in the numbers can trip you up. And so, some of the things, in our answer to our last question, I gave 3 sort of very high level things, and Karen went into a little bit more detail about all the stuff that's underneath those. Well, you got to do both. You have to have the headline story right, and you kind of got to go down to the floorboards to make sure that it stacks up.
Yeah, I would agree with everything there. I think when you're starting to pull together your data room, it really plays out to what David was saying, the detail. I think in advance of any transaction, I think who's on point for your finances. So if you don't have an FD or you don't have a CFO, and certainly by the time you're getting PE investment, I would at least have someone in that a part-time basis. I think you really do need that person to be on point, because what happens is classically, the founder, the CEO, and perhaps a couple of others come out of the business. So the other thing you really want to think about is who's running the show while you've got your eye on the deal and providing all of that. So I think there's a bit of a kind of balance to be achieved. But I think the surprises in my experience often come post the deal, and not always in a negative way, but suddenly, certainly if you're PE invested, the PE investor will say, let's have a construct a board. So suddenly your cozy management team that, was there suddenly has an element of professionalism. And then, we talk about, well, what does the board pack look like? Suddenly more metrics are put into the board pack. So you've got like a structured, you may have met, I don't know, quarterly, PE often like certainly in the UK, a monthly meeting. So you're producing a pack for a monthly meeting, you're producing more kind of data, and it brings many benefits. Like, please don't get me wrong, I'm certainly not trying to put anyone off. I think you will look at your business in a much more structured way, but I think you can often underestimate the amount of time that it takes to do the analysis and so on required, and certainly pre-deal, getting that data room fit for purpose and ready, that you can credibly transact on what information is needed.
And are there any areas that, from a PE side, consistently appear as opportunities they feel that they can add to the firm they've just invested in, aside from just the money?
Yeah, definitely. I mean, on the interventionist side, that often where PE will really help is one in, you know, making introductions early. So it is that independent non-exec or chair. It is in constructing kind of that board. It is around, you know, coming and asking the outside questions that when you're deep in your business, you don't often take that kind of helicopter view. And it's also they bring outside experience. Obviously, they've invested in similar businesses and deals, so they've got a bit of a kind of history on kind of what works. I think from my experience as well, what PE investment has brought, I mean, it's brought all the things, you know, it's enabled businesses to get from your kind of 50 people to 100 people and plus. I think it's really sharpened the focus. So there's a good tendency in many founders, and I recognize this, you know, you want to do everything. I think PE does bring that kind of shorter, sharper focus. Let's do a few things really well. Let's not try and kind of do everything. And let's think about our growth story. So what are the things you need to do before your next twist? But you don't need to do all these things. So you don't need to build 10, you know, products. You only need to build one. You don't need to go in 6 geographies. Think about your current geography, and maybe there's a extension opportunity. So I think it brings that. It also obviously brings de-risking. Obviously, in some instances, there's a liquidity event for the founder in a PE transaction that might be important to people. So there are I've seen challenges, but there are also many benefits too.
Yeah, we've seen in our client base, many of our clients are, even if they're a slightly different size at the time we work with them, they are at a point where they're really bumping up against the ceiling. You know, there is if you think about, if you would ask them, how are you going to triple your business again, which they've probably done 3 times, you know, they've probably got three periods in their history where they think, oh, that was a triple, right? From 1 to 3, 3 to 9, you know, those are increasingly difficult. But if you think about how you can go from 20 to 60, that's typically the one where it isn't possible, or it's extremely difficult. And I think there's 2 things that I think the private equity community has really woken up to in the last 5 years. One is that these are really growth stories, that you can't financially engineer returns in these kinds of high cash flow people business models. So you tend to have to grow into returns. But they've also recognized, and I think come to the realization, that in the right segments, in the right situations, a private equity investor opens up not only a triple, but 5, 6, 8 times scaling opportunities that just weren't available to a founder without the capital, as Karen said, the focus, but also the skills at acquiring other businesses and, you know, sort of creative corporate finance events that add scale and de-risk a business, but open up that $200 million, $250 million revenue opportunity that, you know, as a founder-owned business is really, really difficult to envision and doesn't happen very often.
You've started to touch on there some examples of opportunities where PE have come in and the end result being significant. You know, have you got any other personal stories or case studies or insights you can share with the audience around that, you know, specifically experiences the way you've seen investors coming in and making that really significant impact on the business that they wouldn't have been able to achieve without it?
Yeah, so we've got several examples of that in our recent history. You know, we sold I won't mention names, but we sold a digital transformation business to a private equity firm here in the States, a PE firm that didn't really, prior to this, think about doing a specialty consulting tech services model. They weren't on our list as being interested in that. And they bought this business. I think it was about 30 million of revenue. This is 18 months ago. And, you know, I think that they're thinking about 125, not next year, not in 24, but next year. And that'll be through organic growth and an aggressive acquisition program. And so, you know, I think that this is going to be a fairly regular story, you know, whereas you don't see a lot of $200 million digital transformation revenue companies right now. I think in a couple of years, you're going to see quite a few of those. And I think they're all going to be private equity backed. I think that's how they're going to get there.
Great. Karen?
Yeah, similar, Ben. I've seen a number of success stories. I've seen recently a HR transformation sort of consultancy get backed by PE in the US, went for a higher multiple than anticipated. I think what they'd really done was, or around the IP and methodology, it made a really big difference, and it also enabled that business to go and make a targeted acquisition on the West Coast. For people, but also kind of further IP. I've recently seen a highly healthcare business in the UK, 10 or more kind of bidders on. Again, really a kind of attractive kind of life sciences space. So there are many, positive stories, and I agree with David. I think there's a lot more of those kind of transactions to come.
And on the flip side, what are some of the challenges and the pitfalls, particularly once an investor's come in? Have are there any really common scenarios that you've seen played out, or anything that you can? Yeah, okay, perfect.
Yeah, I think for me, where it goes wrong, and I have to say, most of my experience is highly positive, because I think PE does a really good job of outlining to, a founder or a management team what this is going to feel like, and, ensures that there's been a period of time that they've worked together. Let's not forget, there's probably can be a 3-year relationship before a deal is done. So you classically know each other. It's rare that you come together and you've not known each other for a good period of time. So I think I'd say that. So that for me de-risks it. But where I've seen maybe things not work out, one is just a cultural misalignment. So maybe there's misalignment around the timing of how long is this period going to be in terms of exit timing, or there's generally a cultural, just miss, i.e., you may have brought in a more aggressive PE backer that as the founder was your baby. So it tends to come, Ben, from what is from, in my experience, that probably cultural misalignment, or something may happen. So again, recently I've seen a founder got PE investments, then quickly left the business and hadn't really built up that next tier to be able to take it on. So it tends to be, I put it all under that kind of cultural misalignment. We were on different pages that we hadn't realized until we started working for. But most of my experience, honestly, is positive. If I talk to founders, and they're usually, positive about taking on investment, but I think it's because they prepared themselves in advance. They knew why they were doing it and what they were going to get.
Yeah, I would agree with that. I think expectation management is important, and I think people can convince themselves that sometimes that the world is different than it pretty clearly is. And so when we've seen post-close surprises, it's been when people had just been surprised by things that were known to them. Sometimes accidents happen. Sometimes businesses don't perform the way they wanted to, or sometimes a buyer changes their mind about something post deal. But most of the time, when there's a bit of a learning period post deal, it's because of what Karen mentions, expectation management.
Perfect. So we've got 12 minutes left. So I'm going to open up Q&A. Karen, Tom, David, as you've probably seen, they've been coming in anyway, but for anybody who's not asked a question and wants to ask a question, now is a great time to do that. Whilst I'll just give people 30 seconds to get their questions in, I'm going to post another couple of links in the chat. That's just for a couple more webinars that we've got in February and in March. February sessions on finances for consultancies, and March is more sales and BD. But we've got some opportunities to sign up for those in the webinar chat. Okay, back to the Q&A. Okay, so what are the keys to making a consultancy business seem like more than a set of organic hires to an acquirer? The offers we've seen as a 15 to 20 person, 3 million sterling revenue firm have been little more than 1 times EBITDA and involve lock-in of senior team. What factors tend to drive a higher valuation multiple?
I'm happy to opine on it first. I know David will have lots of
go ahead.
experience there. I think what drives up the multiple and why you're not just like a collection of people, I think one is, have you built your tools, methodologies, IP? So have you got something that's of tangible value kind of beyond people? I think for me, it goes back to what does your classic offering to a client look like? So have you identified that niche? Have you got great examples of how you've delivered for a client and then you've scaled that relationship? And are you, making sure you're not dependent on, any one client? You've got that kind of diversity, and you've got that brand, positioning in the market. It's really clear and distinctive what you do. I see that drive up the valuation multiple as examples, and perhaps you're not just talk about you're not just a PowerPoint and pyramid player. You're doing something more than that. You're building more value, so you're bringing to the client tangible impact on their business, and they would be a reference case for you for other clients. That all those things for me, and that you've really focused. I don't think you mentioned profitability. You talk about revenue, but you can show that clear EBITDA trending in the right direction. So you're keeping a really good eye, around your kind of margin, and you're making sure that you're driving out that profitability. Those would be some things, but I know, David, you'll have tons more.
Yeah, I think a business or a group of people at that size can sometimes seem to the acquirers like a practice area that can be plugged into their existing team. I think what's necessary in order to demonstrate in order to get a higher valuation is really to build a business and to position the team as a business. So to the extent that it appears very dependent on the existing senior people, that if the senior people, if one of the senior people left, it would all sort of unwind. So I think that's where scale comes in. So building a business that has growth drivers that can be invested in, that are separate from just the senior people or getting more senior people or the senior people working harder is critical. So that typically comes with scale. So that's where the fairly or unfairly scale is seen as a proxy for whether or not you've built an independent business model, is because in order to get to 10 million of revenue, you've probably had to answer some of those questions, about how do we grow? How do we add new revenue? How do we approach new clients or new product areas? So, typically that's why the investors will look at scale, because scaling forces you to answer questions about how do we build this as a business rather than just a practice.
Thank you both. Another question here. How do you see valuations differ based on the buyer, e.g. PE buying controlling interest versus, say, senior executives an opportunity to buy into the partnership over time?
Yeah, so Karen, I'll start with this one if that's okay. The valuations, if you think about the three categories, the three big picture categories we were talking about: trade buyer, private equity buyer, or internal transaction. The trade and the private equity, they sort of swap leadership positions as markets sort of evolve, and so sometimes the trade or feel like they're offering a bit more. Sometimes private equity is offering a bit more. And we've seen that kind of swap and change a bit over the past couple of years. But they tend to run pretty close because they're competing with each other. So, in this market, for high growth, sort of scaled assets, private equity and trade are competing, and they know they're competing. So they have to find, they have to stretch, and so we see valuations at that between the two of those categories pretty consistent, depending on the story and the company and the opportunity. The management team buying in typically is done at a much lower value. There's a lot of technical reasons for that. But the fundamental reason is that it's difficult for a business to produce enough distributable income in order to be used for a transition. And so you're talking about people working for their compensation and reinvesting that compensation and buying the business over time. It's very difficult for that amount, for there to be enough money in that, for people to both have the compensation they need, but then also allocate significant dollars towards a transition. So those values tend to be quite a bit lower. And the other reason is that it's often used for incentive purposes. So you want people buying in at a low number, because what you're trying to do is get them oriented in their mind as a shareholder. You don't want to make it hard.
Perfect. Very good. Another question here, which I quite like. Describe the boutique strategy consulting firm with $5 million in revenue that commands the most premium price. I guess what they're after there, reading between the lines, is sort of like ideal gross margin, sort of at the higher end that you've seen, maybe utilization rates at the higher end you've seen. What are some of the numbers that would go with a really attractive boutique consulting firm at that sort of revenue profile? Do you want to go, David?
Sure. So we see sort of best in class gross margins, high 50s. The EBITDA margins, in the 30s. Utilization rates, a funny one, because that can cut both ways. It's got to be north of 70 probably, but if it's 95, then you're going to get a different kind of question. So it's not necessarily bigger is better. But so we would typically see a 20 to 30% grower, with predictable with visibility into that, with 55 to 60% gross margins, would be kind of running at the head of the pack. And then it comes into all the other stuff that Karen was talking about. What do you do? Why do you do it? What do you do it for?
Thanks, David. Karen, did you have something to add as well?
I mean, I agree with everything there that David
Yeah.
said. I think it's back to all the things I was mentioning. I think having some IP and methodology beyond just the kind of people important. I think getting really predictable around your profit. I think getting that sales and marketing engine really automated, putting out kind of thought leadership and positioning pieces. It's kind of working through all areas of your business from a people perspective. They will look at retention. We've not mentioned it, but I know many businesses rely on associates, but it's not being over-reliant. That's absolutely fine to manage peaks and troughs, but you do want a core of people, within the business. So I'd almost be thinking around each dimension of the business. And then, as you say, to get the highest multiple, it's working through each of those. But those would be definite kind of examples. And there's always an element of luck that comes into this. You timed it right, you found the right buyer, at the right time.
Very good. So we've got a couple more questions. So those people that are still asking, because we're going to have to stop right on the hour, I'll get responses after the event. But the last one that I've seen here, I want to put to you quickly, is if founders have handed over all operations, what's the likelihood they'll be retained for the earnout?
So my experience, so if the founder has brought in a management team and that management team is now running the business, I've not seen that founder need to go and do an earnout. But if that person's still operational, and still the figurehead and still running the business, then absolutely they would. I think it's all about it's a timing thing. And then it's getting your buyer comfortable with the people who are, the next twist. But if you've kind of ultimately, sort of exited the business, if you like, then you wouldn't be the person earning out.
Yeah, I think the only caveat we've seen to that is that it depends on the magnitude. So if you've handed operations to the business, to the management team, and the buyer is dependent on that management team, the buyer is going to want significant transaction proceeds to go to that management team. So, if as a founder owner who's transitioning and doesn't want to stick around for the earnout, which is absolutely possible, they also shouldn't have the expectation that they can take 100% of the proceeds. So that's the only caveat. And every one of those answers is different. It's all customized. But if you're not necessary day to day, then there shouldn't be any reason for you to be there or be subject to the day-to-day post deal.
Well, thank you for answering all of those questions and also for giving such great insights throughout the rest of the webinar. Like I said, we've got a hard stop in a minute's time. So I'll also say thank you to everybody who has asked those questions, who's been engaged throughout the session. Like I mentioned, the recording will be coming to your inbox, so do look out for that. Final reminder in the chat is the other webinars coming up. But last but not least, Karen, David, thank you so much for giving us your time, giving us your insights. Both people are on LinkedIn. Follow them. And anything final from both of you? If not, we'll call it a day and hopefully speak again at some point in the future.
No, thank you. Great session. Really enjoyed taking part.
Thanks, Karen.
Yeah, thank you. Thank you, Ben. Thanks, Karen. Thanks, everyone. It's been a pleasure.
Great. Speak to you all soon. Till next time. Thank you.